Thank you both for joining.
Happy to be here.
So it's interesting, the perspective both of you are going to bring, because we have the private market perspective, we have the multi-strategy hedge fund perspective. Everyone knows what this week in the market looks like. It's pretty brutal, to say the least. Ryan, how have you been navigating what's going on? How are you looking at the most recent moves, the most recent volatilities in the broader scheme of things?
Thanks for having me. Let's take a step back. We're 40 days into a new administration, and I think a lot of what we've seen is probably what many of us expected, but what the markets failed to price. And so over the last 40 days, we've seen a pickup in that base level of volatility. Uncertainty has clearly risen. We're clearly seeing a consumer that is a bit worried. We're seeing retail sales lower, University of Michigan confidence numbers lower. We're starting to see uncertainty in the corporate boardroom. And I think that's starting to price into equity markets as well as fixed income markets. We've seen the 10-year rally from what was 480 to now 415. We've seen equity markets sell off 5% plus from the highs. We've seen a correction in the Mega 7. And so we're starting to see some of that uncertainty that's getting priced in through a combination of economic uncertainty and geopolitical uncertainty in the markets. And so for us, what we're trying to focus on in the end of the day is which ones of our strategies are ultimately in a position to benefit from that. How do we set up our portfolio such that we are leaning into the strategies that are more positively convex, that benefit more when the market ranges increase, that benefit more when ultimately the correlation factor of stocks is greater than where it was over the last 12 to 15 months. And that's really what we're starting to see.
Jim, that interest rate part of the equation has been really interesting to see that drop off from 480, as you said, to 415. Stunning move since the middle of January. What is your tariff takeaway at the end of the day? When you look at the market, it seems to be screaming growth scare.
Yeah, I think that, I look at this as really an intersection of, when we came into the year, a lot of, tremendous animal spirits on taking risk on in virtually every asset class. And now we're at a collision between macro paralysis. And so when you talk to folks that are inside boardrooms about strategic M&A, about IPOs and other large cap capital formation activities, there's just really a standstill right now. And certainly in the short term, the conversation about stagflation with the tariffs and other activities and tax cuts, that's got to be a short-term conversation. But, as Ryan said, heightened volatility, access to some companies are sometimes in question. Those are periods when we as a franchise and the world of private capital, private credit, we welcome these opportunities because there's always great companies that need to get financed. But certainly you have a white-hot marketplace that has been punched in the face the last 5 to 6 days about the reality of not one or two initiatives out of the White House, but a dozen initiatives and 70 executive notes in the first 32 days. So it's an extreme time that many of, or if not all of us, have never been through before.
To that end, Schonfeld has actually held up well against its peers in this environment. It's been brutal. A lot of people, as you say, Jim, have definitely felt punched in the face by this market. What's working in this market?
Sure. So as I said before, I think some of the strategies that we deploy that tend to benefit as the ranges of individual stocks expand is what's working. So for us, we've got a big quantitative trading business. When market volatility and market volumes increase, as we sometimes see in these periods of uncertainty, that can be a really beneficial market for some of our quant trading strategies. Some of our short-term trading strategies that can take advantage of some of the momentum or the reversal of momentum in some of the stocks that ultimately probably got to valuations that were too high based off of some of the animal spirits that Jim mentioned. Leaning in and deploying more risk in those type of strategies has certainly worked, as well as some of our volatility strategies that ultimately benefit from the breakdown in the correlation regime that we've seen over the last 15 months. And so those are the things we're leaning into. Of course, some of the strategies that are short vol, that in the end of the day are more momentum oriented, that outperformed, in the post-election period up until Inauguration Day. Those are the areas and those are the parts of the portfolio that are struggling. And so trying to figure out as investors how we square some of our risk in those areas and make sure that we're set up for the uncertainty that's likely to continue going forward. I mean, if what we've seen over the last 40 days is any indication of what we're going to see over the next 4 years, we need to be prepared for consistent tweets, consistent executive action and things of that nature. And so as such, it's really important that we start to reposition some of our portfolios.
You know, it's interesting. And Jim, I have to give you credit because doing this conversation with the two of you was your idea. And I first asked what you both had in common, and it's the Duke endowment, interestingly enough. So you're not only watching this market from the perspective of your own firms, you're also watching it from the perspective of a large institutional investor. A lot of soul searching going on in this market right now. You mentioned animal spirits. Apollo talks a lot about market concentration in particular. What do you think the new truths are going to be about this market as people realize being so overweight, just a small handful of names is maybe not the path forward?
Well, I think there's a lot of questions there. I think we've been very vocal that the evolution of the marketplace, the evolution what's gone in the area of credit, which certainly we feel we're front and center in, and Ryan can talk about his franchise. But if you look at the role that we play today in capital formation of companies, and there's a couple of big misnomers. Private credit is not just the non-investment grade sponsor lending. That's an interesting asset class. We're a big player. It's a $2 trillion asset class. We've been very vocal that the opportunity set is much bigger in the 40 trillion asset class. And I do think that right now, what the backdrop that Ryan described is we've had a very concentrated market, tech-led, and there's a greater degree of dispersion of company outcomes. That's good for real investors. If you're a real money investor, I think that's a way for you to outperform instead of being involved in a passive index or a concentration. So from our perspective, this is the kind of environments that we like, that we expect. There's still a tremendous amount of, with all the initiatives that have been announced, there's a tremendous amount of capital needs from a variety of investment grade companies. And we're poised to be able to participate and provide that capital. But I will say, base rates right now, low fours, mid fours, high fours, when you can look at where you can be a lender in the world of credit around in the US today and in some parts of Western Europe, it's a very, very provocative asset class in terms of the appeal of the duration of that coupon, the compounding, and when you lay that against what's going on right now in the world of equity with volatility. But the basis of my conversation for leading us here is that people really don't think of a multi-strategy firm like Schonfeld and Apollo having a lot in common. But I think if you see what's going on in the asset classes over 25, 30 years, there's a reason why we both ended up in these situations.
To that end, what are you seeing in terms of the ability to kind of dive in as investors start to spread out? General commentary here. I mean, what do you make of the fact that investors were so long NVIDIA and maybe nothing else?
Yeah, I think that's where the opportunity is. And so to the extent that we see the breadth of the market expand, that's really good for our business. Ultimately, we benefit from dispersion, as Jim was saying. And so our job is to identify relative value opportunities across a combination of the asset classes we trade. Sometimes they're more in the equity space, and we can take advantage of that. Other times, we've built out businesses like our macro fixed income business because there are more opportunities there. And so what we're trying to understand across all the asset classes we trade is where is the risk premium mispriced relative to the volatility and the liquidity that exists within that asset class. And when we see meaningful dislocations, which we've started to see, and which, if this uncertainty continues, I expect us to see in an even greater magnitude, we're poised to take advantage of that. And by having experts across a combination of credit, and vol, long-short equity, quant, and each of the different strategies we run within our multi-strat organization, we have the insights, we have the analytics to be able to compare where that risk premium is mispriced and how we can ultimately lean into it. And I think that's what we're trying to do. And to the extent that volatility increases, I think you see more of that mispricing.
Jim, it'd be a missed opportunity if I didn't ask you if your thoughts were changing about your broader view of the world here. You have a lot of investors starting to think about stagflation, maybe even a recession, complex situations around sticky inflation, but slowing growth. How do you navigate what's your base case here?
Well, I mean, Torsten really is our spokesman for the economy. We still think the underlying economy is quite strong. There's a bunch of curveballs with regard to the Doge activities and government, cutbacks of 300,000 people and the multiplier on that. But, I think all the things that Ryan's been talking about, whether it's volatility, in the marketplace, concentration, that brings a conversation to investors to a firm like ours where people are saying, there's a pension deficit. They want to allocate more to private capital, private credit, because the simplicity of compounding and getting a coupon every year. And so in periods like this, we always find ourselves busier than usual. There will be a period where the public markets have a dislocation. There may not be perfect access for many companies. And so for us, like this is the reason we were built for these types of markets, to be robust, to be in business, to hang our shingle 24/7, and such that when companies either facing an M&A opportunity, a strategic purchase, whatever it may be, that we're open for business and can write $5, $10, $15 billion commitments across the debt and equity vertical and horizon. That's what's important to us.
And I want to go back to what you said about base rates still being elevated. You mentioned your fixed income business too. I presume it's part of the same reason. You have base rates elevated. How attractive is the fixed income opportunity to you right now? And would you ever consider privates?
Sure. So for us, we focus a lot on liquidity. And the reason we focus on liquidity is ultimately it allows us to pivot as market conditions change. And so we have stayed away from the private credit space. Jim's the expert in the private credit space, but we've built a credit business. We've built a fixed income business to trade across a variety of the more liquid and tradable, credit asset classes. And that's been beneficial for us in that, when the opportunity is in investment grade credit, we'll be there. When that opportunity shifts to high yield, we can be there. When that opportunity is in Europe, we'll be there from a geographical perspective. And so we think there's enough to do in the more liquid credit markets that's consistent with our conviction and belief in having liquidity and being able to pivot, especially as market volatility increases. And so for us, I think that's the name of the game.
I think the idea of liquidity brings me to, I think one of the most interesting stories for structure in private credit, the ETF that was just put out by State Street that involves Apollo. You have a trading desk now, Jim, also that looks to trade private investment grade debt. What's the grand plan here? How liquid can these markets get at the end of the day? Apollo talks so much about the convergence, but what's the timeline and what's the scale?
Well, again, let's take a step back. Why we're both up here today, I think that when you look at the evolution, I've been doing this is my 39th year in the industry, and when you look at where the credit markets were, the role of, the old Goldman Sachs, the old Bear Stearns, the old Merrill Lynch, and then the consolidation of global banks, it's not a surprise post the GFC that you've got some very large platforms, ours being one of them, and the same parallels happened in the multi-strategy. Back in the early 90s, it was all about single manager hedge funds, and it was a star system. That still may exist today, but not to the same degree. So the breadth of capital, changing our liability, we have long tail liabilities, taking our cost of capital from 20% down to 6%, and being able to bring in the best and the brightest from the sell side. It's changed the complete dynamic of our business. So when you ask what's the end game, having done this for a while, there was a period of time in the early 90s where loans did not trade. Believe me, in 1990, no one traded a loan. Now it's a $2.5 trillion asset class that has plenty of ETFs and trades very actively. Last couple of years, the CLO liability market, AAAs, they were used in the past, they were bought by 7 banks within 3 blocks of the train station in Tokyo. Now there's a $22 billion ETF on CLO AAAs. And so what we're trying to do, I can't directly address it with what you asked, but the reality is there's an evolution into a lot of these asset classes. Our focus is on the investment grade part, not the old traditional leverage lending part. And as more investors come in that are focused on transparency, on information, and on financing those assets, there will be a marketplace for those.
I know you're begging for this question, right? When you think about all the activity that's moving outside of the banking system to you, does that pose a new systemic type of risk?
We've been very clear the U.S. banking system is the healthiest in the world, and the fact that over the last 25 or 30 years that the banks have systematically dispersed risk by the syndicated loan market, by a massive investment-grade bond market, by a securitization system that really, whether it's synthetic risk transfer or other trades, there's a reason why we're the healthiest market in the world. There's a reason why one of the largest, most growing economies in the world, or the largest and most robust economy, why private credit has succeeded here. So we would vociferously have the view that we have mitigated a tremendous amount of risk with less levered balance sheets and longer duration liabilities.
And just to add to that also, the fact that the banks are much more focused on market-making activity instead of the proprietary trading activity, and that proprietary trading activity has shifted to buy-side institutions, whether that be the Apollos of the world or the Schonfelds of the world. And so a lot of the types of trading businesses that we run today are trading businesses that existed inside the banks that, in the end of the day, do take risk and do, ultimately take the other side of certain transactions. And I think whether it be the index rebalance business that was very popular in the banks, in the 2010 to 2015 era, that's now much more popular on the buy side, or some of the Delta One businesses, or certainly some of the macro fixed income businesses that both Jim and I both run. I think these are all examples of things where that risk has shifted from the sell side to the buy side.
So when you look at them, yeah, go ahead, Jim.
And I would say, when you think about, I think from our perspective, we've partnered with the banks as strategic partners from origination, whether it was Citi or BNP or large financing arrangements with Standard Chartered. We've found a spot where either we're pari passu with a longer tenor, or we're senior junior, or whatever it may be. The same can be said certainly for the prime brokerage business and the securities lending business, where the largest institutions are focusing on the largest multi-strat funds. And there's a degree of dialogue and senior leverage that occurs across our organizations. And we both have seen the consolidation of resources and dialogue and flow, and want to make sure we position our firms collectively to be able to be the partner with the banks in those areas.
In the hedge fund world, the multi-strat world has gotten such a big role in the world of hedge funds more broadly. So what risk are you most worried about then? People talk about concentration, leverage, but what is it for you, Ryan?
Yeah, I mean, clearly the largest risk is ultimately crowding risk. And so, I think given the way in which some of the risk has transferred to the multi-strats and the multi-PM organizations, you have to focus and understand where people are positioned, where the crowd is. And so what do we do about that as an organization? We try to invest and we try to build businesses where there are larger barriers to entry, where it's not so easy to stand up and replicate a business like some of the things we do overnight. And so we touched on the quant business earlier. One of the reasons why, if you look at our risk allocation to the quant business as compared to many of our peers, we are more allocated to that business, is there are a lot of barriers to entry. It is hard to stand up a quant business. The costs are high. The cost of acquiring talent is high. The cost of building and maintaining a data platform is high. The cost of investing in consistently upgrading execution infrastructure is high. We've been doing it for multiple decades as an organization. And so we have the benefit of not only the long-term investments we've made from a CapEx perspective, but also the recognition that we have a bunch of proprietary data that ultimately cannot be bought off the shelf. And so when some of our peers tell us that they're trying to build new quant businesses, we sit there and we say, good luck. It's really, really hard, and the barriers to entry are high. And so the way you protect yourself from the crowd to a large extent is you make sure that you have more risk allocated to some of these businesses where the barriers to entry are just higher.
And in our example, the comparison, again, to compare and contrast, we had a view that in many asset classes, the perception and the reality of investor is size is an enemy in many asset classes. In the world, the reason why we are so large in credit is scale is a massive advantage. We've taken our cost of capital down dramatically. And when Ryan talks about the quant business, you've heard me talk about it, Sonali, we are focused on the origination business. Many asset management firms are focused purely on raising capital as the competitive benchmark to success. We think it's all about your ability to originate proprietary deal flow. And so for us, we spent a decade, spent almost $9 billion, 16 origination platforms, 4,000 people that every day come on in and produce that safe, secured yield for us. So for us, we had a vision 15 years ago where the industry was going, and we wanted to build a machine that would really be able to take that on, ready for this prime time activity.
I keep making a joke that origination is the new hot job on Wall Street, but stick with that for a second. You have done something else that's been fairly new for Apollo's history, which is acquisitions. And you look around the industry, and in the private credit world in particular, just an enormous amount of consolidation. What's the strategy here?
Well, we've done a variety of smaller tuck-in acquisitions, and before I got to Apollo, I spent 20 years on the sell side at Goldman and Citi, and having been through a few acquisitions, they're culturally challenging. Embedding a culture, an investment culture, a risk-taking culture with new people is always hard. So we've chosen to do very, very small, add them into our business, whether it was Gulfstream, or other things that we've done, or Stone Tower in our credit business, or mid-cap. We've chosen to be very small, have them get up to speed in our business for a while, and then really scale it over time. So I do think just having a toolbox with lots of different brands in it and showing that to a borrower, I think that's a cumbersome toolbox. For us, we need to be really on the same page.
Look, and just to add on to it, in our space, I do think that throughout our history, looking at different acquisitions and thinking about how we grow through a combination of partnership, joint venture, or acquisition has all been a part of the Schonfeld story and the Schonfeld DNA. I think about how we ultimately stood up the Asia business, and we considered a bunch of different alternatives before we decided to expand into Asia. One was to try to start a business organically, but ultimately we chose the path to first form a joint venture with another asset management organization, and ultimately when we had the opportunity to then actually go out and acquire that business in Asia. And I think about that business, and to Jim's point, at first there was a lot of cultural challenges as it relates to the integration of the two businesses. It was roughly 50 people at the time in which we acquired that business. But today, that business is 225 people for us. It's roughly 25 to 30% of our risk. We made probably 30 to 35% of our P&L in 2024 out of the region, but it was ultimately sparked by some acquisition.
But would you be open to more in the future?
Yeah, of course. I think we've got a business development team out there that's roughly 30 people, and we're out there looking for different opportunities every day. Sometimes those opportunities just come from bringing some new talent, into the organization, and sometimes those opportunities come from acquiring new businesses. And so when I look across the suite of strategies we trade, certainly as it relates to expanding some of the existing strategies, there are acquisition opportunities that we're considering right now. When I think about expanding into new strategies, it's always easier to think about and look at if somebody's been there and done that before. And so when we built out our macro fixed income business, that was an acquisition opportunity. That was a business that was going to think about getting started as more of a single strategy fund, but recognized that there were economies of scale in ultimately bolting on that business to a broader platform that traded a variety of different investment strategies, where ultimately the data, the insights, the analytics that we have within the platform could be shared to create something better than what a single strategy fund does.
Before I let you go, would love for both of you to lean in, because both of you have talked about your people. There is a talent war going on that is very significant in both of your businesses. How do you win it?
Being Apollo. We have an amazing brand. No, we're very fortunate. We have, for every position that we post, there's a line over the transom of great applicants. It's not just been the last 6 months, it's been the last 15 years. And you don't grow like we've grown with great senior talent across many parts of our organization. And again, I think, Ryan talked about it. Whenever you want to do a new business, it's buy versus build. We find that when you go on your own, there's a tuition you have to pay. So a small acquisition that forces you at the edge to figure things out, we find that's the better way to go. But the human talent, we are in the ultimate human capital business. It's what drives us. Mark and I spend so much time talking about it and leading by example. So listen, by no means is it over. It's a constant marathon.
I'll say two things on the topic. One,
You can't steal the answer, so.
great talent attracts great talent. And so if in the end of the day you put great talent in leadership seats, that's the number one path to victory. The other thing that we say at Schonfeld is ultimately talent development and talent retention ultimately is the tool toward talent acquisition. And so if we have great risk takers and ultimately we build great businesses with those risk takers, they become the greatest ambassadors for us recruiting future risk takers into the organization. And so that's how we've gone about trying to build our business at Schonfeld, which is have an industry-leading talent retention rate.
Thank you both so much. Very complicated market, but a lot of change in your businesses. We really appreciate you taking the time with us today.
Thank you.
Thank you.